Hi, everyone, and welcome to this month's edition of On Track. I'm Rob McGregor, and this is our monthly update for the end of June, so the end of the financial year, with all the news right up to today and all the performance data for the 12 months ended to June 30. So let's dive in. But before I do, as always, this presentation, this video is prepared for clients of McGregor Wealth Management, particularly those that use our care investment methodology and care process. All else, welcome to listen, but please get advice to make sure anything we talk about is suitable to your own circumstances. I'm going to go through all the news. It's a funny old world out there. In a crazy old world, we finished up in a good year, in spite of a whole lot going on news-wise, which is testament to our long-term beliefs that the markets will continue to rise through a whole lot of weird stuff. Let's have a look at some of those highlights. And in Australia, the RBA leave the cash rate unchanged, which surprised the market. 98% of the market had factored in a drop, but the governor was adamant they just need to wait a little while. They remain dovish, so they still know that interest rates are on the way down. The market's still predicting 3.25% by December. So at the moment, that cash rate is 3.85. It's come down, from 4.1 over the last few months. It will, 3.25. That's what people talk about as the neutral rate potentially, where we're neither stimulating the economy nor got the brakes on. So it's a moving target potentially, but 3.25 would be considered neutral, and we'd be there by December. That'll make other rates interesting because it does affect other rates. At the moment, 90-day bank bill rates are 3.71. So that's under the cash rate. That's the market anticipating going down. 10-year government bond yields, not much change, up slightly, 4.35. We're really seeing them bounce around that level. The Aussie dollar, 65 cents. It's sort of going up, but slowly. And Aussie inflation, 2.1%. Sounds low, but there's still the effects of some of the government stimulus in there. So they're looking for just a bit more stability. And obviously there's uncertainty. In the US, they also left the cash rate unchanged. US inflation has bumped up a little bit from 2.4 to 2.7 as the effects of some of the tariff price increases come in. And the Federal Reserve over there are really wanting to see what's going to become of that. Despite Trump sort of pushing the Federal Reserve to drop rates, it's kind of not happening just yet. But once again, the market does predict that will happen. But it's a lot more uncertain in the States because of no one's really sure where the tariffs finish. We saw last month, I was talking about oil prices. We had the war with Iran, Israel, Iran, with the US chipping in with their bombing. It had spiked oil price. I'll talk about that in a minute. But that's pulled back. And the markets are really, if you look at the chart down the bottom, you see the red line is the ASX 200. And it's had a solid year. It's up about 13%. But 1/3 of that is due to CBA. So look at CBA, which is the blue line. CBA is up, well and truly, I think it's about 28% for the year, despite it not showing any signs of growth. So CBA is now officially the world's most expensive bank on market valuations. It is arguably one of the world's most quality banks, but it has no growth factored in. So it's quite odd. Almost unanimously, every active fund manager thinks CBA is expensive, but those that have acted on that and been out of CBA for the last 6 months have massively missed out and underperformed. So it's an issue for active managers. It's nice that a lot of our exposure comes from the index. CBA now makes up nearly 12% of the index. So in terms of mortgage rates, we're seeing them start to move independently, slowly going down. Mortgage rates 5.48%, the lowest variable we can see. Seeing some 5-year fixed rates at about 5.3, which makes it interesting for property investors, knowing they can lock in 5-year fixed rates at 5.3. Macquarie's variable is down a bit at 5.64, despite no interest rate drops. So you can see the bank's starting to position, anticipating that rates will be lower. 1-year term deposits are still about 3.8. You can get more for a 6-month or a 3-month term deposit, but it's unlikely you'll get those same amounts when they're renewed. So let's look at portfolio returns to the end of June. So as I said, the end of the financial year. And I'll compare these to some market ones in a minute. So very happy with the care portfolios. Sorry, I'll just go back there. Very happy with the care portfolio's performance, both over 1 year, 3, 5, 7, and 10. Doing very well and on track for the targets that we sort of set. You'll see the 10-year returns. I'm going to put them into context because we report these to you guys and they sound pretty good, but it's really hard for you to tell how they fit compared to others. And I'll go through that in a minute, but good, solid results. At our investment committee last Thursday, which I did from Indonesia on my travels. I was in Sumbar, Indonesia, dialed into our investment committee where we had lots of really good discussions, but left our dial, our money on the move dial, unchanged at 10. So we think the market's a bit expensive, not crazy expensive, but a bit expensive. It doesn't mean it can't keep going up. It doesn't mean it's going to go down, but it's just where the valuations are. Markets stay expensive for a long time, and certainly not in the crazy boom or bubble stage. So here we see the wall of worry quite plainly. You'll see on the right-hand corner, we've now surpassed the pre-Trump tariff tantrums. I guess I haven't labeled this one, but we're going to call it fear of trade war on Trump's tariffs. I think down 14%, and that's one of 7 downturns, more than 12% since GFC. All of which passed, and all of which, while that's been occurring, the market has more than doubled while paying 4 to 5% dividend. So a great result for those that avoid the worry and stay long-term invested. As I said, I thought I'd just have a quick focus on the oil price. We saw that spike you can see on the right-hand side, the spike on that wall with Israel and Iran, where oil price jumped dramatically. Oil has been in a fairly long-term downward trend, as there's plenty of supply and demand in theory falling as we move to alternative energy. But every time, we're still very much reliant on oil for lots of things, but becoming less and less so. Then we see that price just drop. And that was as it became clear that the war with Iran was not going to escalate. Or that's the consensus. I put in the fingers crossed there because no one ever knows on these things. But it's dropped and settled there, which took the heat out of what can otherwise be inflationary, which is one of the worries. If oil prices go up a lot, it feeds into inflation as transport is still very dependent on oil. So in my exciting life, boring money, I thought I'd ponder on the results that philosophy has brought over the last year and over the last 10 years. There was an article in the Financial Review a couple of weeks ago, which pointed out the top 10 performing super growth funds. Now, these are the large funds, the industry super funds and other big institutional funds, but I thought it'd be interesting to compare. Now, one, Legal Super, 12.9%, and then they dropped to be pretty all close around 11%. These are growth funds, so I compared it to our care growth strategy, and over the last 1 year, we did 12.66%, so it would have been pretty much at the top of that ladder, just under Legal Super, which is nice and rewarding to know. Then I thought I'd compare over the long run. There's a site called InvestSmart. InvestSmart is a DIY portfolio service run by Alan Kohler and Paul Clitheroe. They're on the board of that. It uses very simple ETF portfolios, and they're okay, but it's pure and simple. There's no smarts in what they do. There's no tactics or anything. And you'll see their returns, 1 year 9.95. So they're very much in that sort of, just below that top 10. But you'll see the average of all the peers, 387. And once again, you can see our care balanced approach, which is comparable, 11.62, so well above the averages. But I want to have a look, sorry, I'll just come back to that, at the 10-year returns. And you'll see over the last 10 years, their portfolio, quite similar to a lot of index-based, purely index-based portfolios, 10 years balanced, average 5.58%. The average of the 387 peers that they monitor, 3.84%. Our care balance approach over that same time, 7.37. So nearly 2% clear of their return and 3.5% clear of the average fund. That's massive over 10 years. Just think $1 million. 10 years, 3.5%, 35,000 a year. It's $350,000 of extra returns compared to the average. And as I point out, the average is the middle. So imagine the ones at the bottom, 1 or 2%. Occasionally we see funds that have done that over the last 10 years. Pretty sad. So just wanted to say congratulations to you all and to us for good, solid returns. And the main secret behind this is mainly index with a little bit of active and mainly passive with a little bit of tactics every now and then. So neither too much decisions, which kills a lot of those peers, or neither too little decisions, which you'll get from purely index. So very happy with the way the portfolios are going and have gone over the last 10 years. Pretty bland on interest rates. You can see in the top on the right-hand side, both Australia down the bottom and the US up the top are just weaving around that sort of 4.4%, waiting for cash rates to go down. If cash rates did go to 3.25, we sort of assume that 10-year bonds in a neutral world would be at about 4.2, anywhere from 4 to 4.2. But the 10-year bonds are always looking at what's happening next. So at the moment, they're flatlining, a bit uncertain. And the 10-year bonds is important because it affects the valuation of everything, because this is the risk-free return that people can get if they invest in government bonds. So whenever it goes up, it causes other assets to go down. Whenever it goes down, it causes other assets to go up, just because of the way people value assets. So, but stable is pretty good. Dropping a little bit in the next few years is part of the reason that markets, share markets, etc., are positive. As I said, in that wall of worry, I'm just reiterating that process we know the market goes through, which is most of the time the market's in a wall of worry. Occasionally we stop worrying and have a boom. That boom is followed by the bust. We haven't had a boom-bust cycle now since 2007. So one will emerge eventually, probably driven by technology and AI, but we're not at that stage of crazy boom as yet. We're a little bit expensive, as I said, the dial at 10. The reason we show all this stuff is to make our investors feel confident that we can ride through ups and downs. We can't predict them. We can manage well around it, but you can see on the right-hand side, after every decline, market has recovered and recovered well. I'm going to focus again on short-term focus because that's, and I'll talk through another behavioral bias in a minute, but all of those average to below average funds are often where they're over trading or they're focused on short-term news. Our active portfolio, I didn't cover it, but over the last 10 years, it's more than 10%. And we're predominantly indexed, but we've got a really good strategic asset allocation there, including gold, which has done well. But we've made 5 decisions to protect profits in that 11 years. So just 5. Lots of funds are out there trying to pick and zip and zap and pick every little 5 to 10% downturn. We do not do that because we know it kills money. And part of that is evident in the Dalbar study here, which shows and has continued to show that investors underperform their investments by 2 to 3% over the averages because they chop and they change. And part of that is that short-term focus. This was an interesting behavioral bias. You don't hear a lot. Tracking error regret. So tracking error is the difference between the index and the results that were achieved. So we saw back in that chart, index about over 10 years was about 5.58 for a balanced fund. So if the tracking error is the amount away from that. So we were above that by nearly 2%, but the average was nearly 2% below. So why is the average below? Because active portfolios run what they call a tracking error. So this year they're a bit less CBA. That's cost them. Other years they'll have a bit more of some shares and a bit less of others. That's caused a tracking error. So that means they'll perform differently to the index. So tracking error is the regret that investors feel if their strategy underperforms a benchmark over a period of time. Now, that regret can lead them to making bad decisions because they may change at the wrong time. They may need to change. One of the challenges of when funds underperform is working out whether it's just their style. So whether it's just winter in terms of their style underperforming and that'll come back, or whether the manager that they've got is just doing badly. So this is one of the reasons we don't love active management, except for very specific purposes or smaller parts of the portfolio, because when they don't perform, or even when they do perform, it's hard to know whether that's skill or luck, whether things have changed, and that can lead to bad decisions. One of those, tracking error, regret. All of that's about behavior, and you can see with all the different results out there how behavior can compound. All of this means the difference of 2 to 3% of extra returns is millions of dollars to many people over a lifetime. Let's have a look at what happened during the year. So Aussie shares, as I mentioned, 13.67% for the last 12 months, 1/3 of that driven by CBA. Quite remarkable. You can see down the bottom left-hand corner, Commonwealth Bank. This is the ASX 300, so VAS. So it's 11.65 of that. The 200 is 13%. So a massive bit. But look at the forward PE, 27.25. So very expensive for a bank. Once upon a time, all the banks traded on PEs of 12, 14, 15. So it's twice that. You can see if you go down, National Bank and Westpac are on forward PEs of 15. So CBA is valued almost twice as much. It would seem inevitable that at some point CBA will have to either fall to get back to the pack, or it just won't go up for long periods of time. So, but that may or may not happen. They may have more profits. They may take over. They may transform. But for now, the broader market, partly due to a lot of passive funds and index flows, is pushing CBA up. And for some of the international, this is where everything's connected. The Trump tariffs has prompted a lot of US fund managers to switch to other parts of the world. So when they are switching big amounts of money to somewhere like Australia, they buy more of the bigger companies like CBA, which pushes them up regardless of their fundamentals. So, but a good month and a good year. And you can see we're now above where those tariffs, where the market was pre-tariffs, and compounded over the last 10 years. 10 years, just 8.8% for the Aussie share market, but that's meant 10,000 growing to about $25,000. So compounding is a beautiful thing. US shares over the last year, 17.3%. We've just talked about the Magnificent One in CBA. The US dominated by the Magnificent Seven. So you can see Apple, which ironically has pulled back a bit. So it's showing minus 5% for the last 12 months. Microsoft, one of the Magnificent Seven, up 16%. NVIDIA, massively up 42%. Amazon, 23%. Meta, which is Facebook, up 48%. And Google, only up 4.6%. So Apple and Google are lagging their fellow Magnificent Seven, but the others certainly making up for it and contributing most of that 17%. Over 10 years, 14% for US shares. That's meant compounding was 4 times, so 10,000 to 42,000. And you can see in Aussie dollar terms, we're just about back to where they were in February, March. Global leaders, almost the identical, same story because it's almost the identical stocks, and 14.8% for the year, compounding up to 42,000 as well. You see those same companies, mostly listed there with a few exceptions. US small caps, which is the heart of the US economy, which has been underperforming a little bit, only 6.29% for last year. We think they're fairly cheap. And we think the next stage of growth will be as the benefits of technology, AI technology comes in, we'll probably see for average companies make more money because of technology. It's a bit like what happened in the tech wreck or the tech boom in the late 90s, and eventual tech wreck. Yes, the technology changed with the internet in particular, but that led to broader companies eventually making more money and lowering costs as well. And the same thing is likely to play out with AI. Emerging markets was a comeback year after 3 or 4 very ordinary years. The 1 year return there, 16.94%. So it's a one for the patient. And as one of our quotes says, the share market transfers money from the impatient to the patient. And we've consistently rebalanced, topping up our emerging markets while it was down and enjoying the reward as it has a great year, and 4% in the last month. partly that on a weaker US dollar, and partly on a lot of the emerging markets, includes China. And there's for a while, back over the last few years, they were undervalued because there was a bit of sovereign risk with China, with the argy-bargy with the US. You'd argue it's still there, but China's showing plenty of signs of being wanting to play in the international economy and not cut themselves off. So we see their version of the Magnificent Seven. That's things like Tencent and Alibaba, which are still very low price earnings ratios, 12 and 17 respectively, compared to the high 20s and 30s of the Magnificent Seven. But they returned 41%, 55% respectively last year. So that's been part of that boom is coming out of China there. Gold, what a year, 42% in a year where stocks did okay as well. So gold in the active portfolio has helped contribute to the solid return. I think we had a 19% return. The active portfolio over the last 12 months, which is where we do make tactical changes from time to time. We're long-term holders of gold because it is many things. It's insurance against volatility. It's a currency hedge as the US dollar becomes more worrisome to some. It's inflation hedge. So keep in mind, it's a small part of the portfolio for a reason. Some people will go massively into gold when they're worried, but gold produces no income. So that doesn't help pay the bills. So we believe, a reasonably modest exposure to gold is suitable, which has worked. Let's jump into property, and not much change here. You can see over the last 3 months, the averages about the 1.4 to 1.6 in the regionals. Darwin is the star people of the last quarter, so up about 4.9%. And regional South Australia up about 3.3, regional WA up about 2.7. The rest pretty much in that 1 to 1.5% band over the last 12 months. The averages tell a tale of two stories here. So while the averages are 3.4, we've got areas like regional WA and regional South Australia up around 12%. And then you've got areas like Canberra, Hobart, and Melbourne and Sydney with almost no growth. So even though the averages come out in that 2.7 for the capital cities, 5.5, we've got much higher in some areas. And note Perth, Adelaide, Brisbane, all up 7 to 8%, Darwin 6%. So this is a classic where averages don't really tell the true story, with each city running its own race. Rental yields, you can see on the right-hand side the fall of rental yields. They rose again a little bit in 22, but they've stabilised about 3.7%. Once again, a big difference. You get a lot of rental yield in Northern Territory. But once again, whenever you see high rental yields, you're not going to expect a lot of capital growth. Rental yields are the lowest in Sydney. And that's where you generally get more growth, less return, less income, more growth. So it depends what type of investments someone's looking for. Interest rates is all quiet. There's no change on the averages, but I've put in there, starting to see, note now that the average 2-year fixed rate is below the average variable rate. So that means the banks and the markets are anticipating a downturn. The lowest 5-year rate I can see is about 5.3%. So I'll just repeat my philosophy around interest rates and fixing them for mortgages. There's 2 reasons you would fix a mortgage rate. One is if you're predicting that the market's going to go up, then you might lock it in. Predicting is very hard. And over history, all of us have a terrible track record of predicting mortgage rates. Mortgage rates are up in the 17, 14%. I remember in a past life, I was CFO of a stockbroker, and as rates dropped from 10% to 9.9%, we decided to lock it in for 5 years because that was the lowest rates had been for 20 years. Well, the next 3 years, rates dropped to 6%, which made us look pretty silly. So predicting is really hard. The second reason to lock in interest rates, is the one I prefer, which is budgeting. So if you're doing the maths around your investment property or even your mortgage, and you just want to know to get some certainty. So at the moment, a 5-year fixed rate of 5.3% looks attractive. Obviously, if rates drop significantly, but if you're going from 6 to, if rates would have to go down to sub 5 over 5 years for that not to be a good rate. So all of a sudden, for longer term property investors who would like to lock in cash flow we think that's probably starting to look like a pretty good deal. And what you'll notice here is the fixed rates have dropped before the cash rate drops because it's in anticipation. Once the cash rate drops, what you'll see is the variable rate drop, but not necessarily the fixed rates because they've already anticipated. So yeah, so it's interesting times there. No changes to the property clocks that we monitor. I just want to point out that these two are quite different. The one on the right is about what's happening to prices. So, rising market, peak of market, declining market, bottom of market. So that's put out by Heron Todd White, who Australia is one of Australia's biggest property valuers. And it's really good to know what's happening. The one on the left is more about value. So that's from Performance Property. And we use Performance Property to help clients find investment properties where appropriate and suitable to their strategy. And theirs is more predictive, which you'll see the word value at the bottom. So they're looking for value, not about. So these things, one, they're not perfect science, but the valuation is what we're looking for. And for those buying properties at the moment, the attractive areas Melbourne's starting to look attractive, and the other areas that have got some value and momentum, Perth, some of North Queensland, and some of the others have run up a bit and are looking more toppy in the market, particularly places like Sunshine Coast where we are, and that's because of the incredible run they've had since COVID or post-COVID in more particular. So no change there. Once again, I will wrap. It's been a good year. It's been a good decade. The care investment portfolios are just about to break through for the first time $4 billion. So that's $4 billion we look after on behalf of all the clients of GPS Wealth that we run these portfolios for. So it's a significant milestone. Our philosophy hasn't changed. Our team hasn't changed. And the value of the money doesn't impact how we do it. The magic of managed portfolios, if we make a change to a portfolio, it cascades across every single client instantly, all at the same price. So it really is a powerful tool. So just reiterating, as I do, because it is so important, all investing, these are our core beliefs, all investing best done as part of a real plan, which is based on you, your goals, and what's important to you. The portfolio is designed to meet those goals over the long term. We do take that long-term view. So we then get down to the boring bit: diversification, asset allocation, and managing liquidity with a few tactics thrown in. You've seen the difference that makes compared to just vanilla indexing, but we do use low-cost index as the base for nearly everything, but with a little bit of active management around it, a little bit of tactics around that as well, but not too much on each of those. Protecting against that short-term volatility through our reserves and dollar cost averaging and rebalancing regularly. So we love periods like this year. That downturn that we had with the Trump tariffs enabled us to rebalance the portfolio throughout that, which when the market's just gone down and back to where it came, that delivers a profit, as does dollar cost averaging for our accumulators. So as always, there's only 3 ways to lose money when investing around the share market. That's panic and selling when the market's down, having to sell when the market's down, and not properly diversified. You guys are very good at not panicking, and by setting up well, we haven't had to sell in any bad times and not properly diverse. And we are completely and massively diversified. So that's led to those good results. Thank you as always for listening. I know there's plenty of other things to be listening to. And until next month, Rob McGregor signing off.